Good morning, everybody. My name is Barry Winters, and I'm with KPMG in San Francisco. And we are really excited to be co-hosting this event in partnership with HedgeWorld. So, the first panel discussion today is all about building an enduring business, new ideas, new technologies, new frontiers. And we have some very distinguished panelists with us this morning. I'm sure it's going to be an extremely interesting discussion. Our first panelist is Peter Algart. Peter is founder and CIO of Algart Capital, and Peter oversees the investment team at ACI and serves as both their CIO and CEO. Prior to founding the firm in 2002, he was the managing director at Barclays Global Investors and served as the global head of research of their stock selection strategies. He also served as assistant professor at UC Davis. So please help me welcome Peter Algart. Our next panelist is Adrian Fairborn, managing partner at Exception Capital, and prior to founding Exception Capital, Adrian built and managed the highly successful hedge fund funds operation at Bank of Bermuda. Since starting Exception Capital, Mr. Fairborn has spent 2 years in Shanghai, where he helped lift out the Chinese private equity team at Temasek, the Singapore government sovereign wealth fund. Since 2010, he's been managing the private wealth of a Milan-based family. So please, again, let me please welcome Adrian Fairborn. And our final panelist is Nancy Davis, the managing partner and chief executive officer of Quadratic Capital. Nancy began her career at Goldman Sachs and spent 10 years at the firm, 7 in the proprietary trading group. Nancy became head of credit, derivatives and OTC trading for Goldman's proprietary group. And Nancy resigned from Goldman in 2008 to join Highbridge as a portfolio manager. At Highbridge, Nancy managed 500 million of capital in her derivatives-only portfolio. So please help me welcome Nancy. And finally, moderating this panel will be Rachel Minard. Rachel is founder and CEO of Minard Capital, the first full-service global marketing and asset-raising firm that is not a third-party marketer. Minard Capital is a supplement or replacement for global marketing teams to help identify, qualify, grow and close new business. Before building Minard Capital, Rachel built and managed global institutional investment businesses for 20 years, including 12 years building fund of hedge fund firms, notably Cadgan Management and Corbin Capital Partners. She has raised over 10 billion in the course of her career. So please help me welcome Rachel. So Rachel, the stage is all yours.
Thank you so much. Thank you all very much for being here early this morning. We look forward to it. It's going to be a great 2 days. Thank you to Reuters and HedgeWorld yet again for the opportunity to present to you. I have 3 exceptional investors and panelists and friends today, and in the next mere 35 minutes we get to have a conversation with you about building an enduring business. As will be evident by their history, which you've heard some of, but their understanding of the market and their interest to build something that is truly enduring, not just a quick idea. We get into their investment principles, how they were founded, and then the application of those, not only in the resources that they're adding and building to their business, but what it is they're looking to have as their legacy. I'd like to start with Peter, specifically talking about a bit more about his business, but more importantly, what were his investment principles early on from Barclays days and otherwise that he is now manifesting in Algart Global, and how does that lend itself to the type of business he's looking to build. We'll do the same with the other 2 panelists, then move a bit deeper, specifically talking about new ideas, new ways to be thinking about the industry, because it has forever changed. Even after '08, reputational risks, headline business, operational, regulatory, etc., have forever changed the landscape and thinking about what is now actually quite a high benchmark, because it's quite expensive, as all of you well know, to build an enduring business today. It's not just simply raising capital or having even a seemingly impressive track record. There's so much more to it now. And so given that, I'd like Peter to maybe speak to the investment principles that guide him every day, how they were started from his early career and their manifest today. Peter?
Thank you. So, we're an interesting firm in the sense that we've been in business for 11 years, but we're essentially relaunched or rebuilt the business this year. But I think the first thing we started with was, who do we want to be? I mean, we had a core concept of what our goal was. We wanted to be best in class in systematic equity, and that's always driven our firm vision and the actions we take. And so we manage stock selection strategies globally in developed and emerging markets, both long only and hedge funds, market neutral funds for institutional clients primarily. But I think that culture of trying to be best in class, we don't want to be. I mean, we have a clear view of who some of the firms are that we like to be compared against, and they're much bigger firms. We don't want to become them. But we want our investors to be the same investors that invest in those firms and believe us to be best in class in what we do.
Nancy?
So at Quadratic, we are very excited. Our principles of the firm are to partner with our investors, number one. Our clients come first, and that's paramount to our principles and our culture at Quadratic. Number two, we want to deliver an uncorrelated return to investors. We are a fundamental global macro fund, but fundamental global macro strategy, but we express all of our views with options and swaptions. So we have that very asymmetric payout, which delivers an uncorrelated, potentially negatively correlated return in a risk-off environment. And finally, in our strategy, we're also looking for that transparency into the options market. So partnering with investors to deliver information that you see. If you look at a spot price or a forward price of a security, you see where the asset is today or where it's expected to be in the future. But the wonderful thing about the options market is it tells you the probability distribution. And that's a lot of information that investors can use relative to their other holdings in their portfolio.
Perfect. Adrian, thank you.
We're slightly different in that we've come up with a very simple but very unique concept of the way to grow our business. The introduction mentioned the Bank of Bermuda. That goes back to the late 90s when when I was building the alternative investment business at the bank that eventually got subsumed or bought by HSBC in 2003. And then I ran a multifamily office in London for a number of years before starting Exception Capital. And it was those experiences of building an alternative investment business and investing into hedge funds, particularly at a nascent stage, but also the experience of a family office investment environment of a very broad investment mandate that really governs what we do now. We run a fund called the Family Fund, which we own the name. We've trademarked it. It's effectively the one way of looking at it is it's the endowment fund for families, as it were. And it wraps a classic family office portfolio in a fund structure. You know, how would you define that? Roughly 50% of the fund externally allocates to managers, no brand names, people that I've known for a number of years seems to be the common denominator. And then 50% of the portfolio invests opportunistically into direct private deals, into public equities, direct structured credit deals, a bit of arts, which is a nicely non-correlated return. And we started 2 years ago, and we're up about 36% in the 2 years. We're up about 11.5% this year. It sort of proves the model. And I guess we'll come on to talk about how that is our way of really building an enduring business as we move forward and grow.
Peter, you have the advantage, and we've spent some time talking about your history, really looking at Barclays to today and its the evolution of the business as a business. In thinking about building your business now, what new things, what new hurdles are you thinking about needing to recognize and think about that you maybe didn't early on? Granted, coming from a large bank or coming from a large firm to your own, but even the changing tide of the industry itself, and even your own strategy. Mm-hmm. How has that evolved, and what new ideas can you share with the audience in the context of what one should be thinking about that they maybe didn't even have to a few years ago?
I mean, for us, it's ongoing R&D. I mean, that's the reason we all come into the office. We're trying to get better and do new things all the time. And I think if you're not doing that, you're going to go away. And they're new products, but they're also just getting better at the existing strategies that we have. Now, technology is a big part of that. We're quantitative. We use lots of data. We obviously have had to invest a lot in big data processing, or smart data, if you want to call it that, natural language processing. Your business becomes different. You're not investing in internal technology infrastructure in the same way. You have to have your backup facility in the cloud. You're using even how you do desktop support. You don't do that in firms anymore of small size. You use only software on the cloud. So just the business aspect of things are very different. And then on the investment side, we're always looking for new data sources and new ideas that can make us better in the strategies.
Are you memorializing those, just as an aside, differently than you had before? Are you having to present that differently to investors than you have in the past?
Absolutely. I mean, one of the things in our communicating of performance to investors, we're using much more of the new data visualization software, Tableau, Spotfire, ClickView. If you're not familiar with those, you should take a look. And it's really democratizing the ability to create much more intuitive ways of explaining attribution and risk and exposure in the portfolio. We showed it to a recent big sovereign that was in, and they said we should be doing that with our attribution. So it's a way for us to use new technology, because that's what we're about, to engage with clients in a way that's beyond just the return stream, but maybe helping them see other things, as Nancy mentioned, in their portfolio, getting a value out of the relationship.
Thank you. Nancy, it's funny, you talked to so many people that came out of Goldman and bigger firms, and while there's a seeming benefit because of resources, brand name, pedigree, reputation, all that, there's also oftentimes an onerousness and a heavy weight because of committees, decisions having to be made, silos and responsibilities. Is there a nimbleness and flexibility in having built your business now that you look forward to that maybe you didn't have in what would seem to be a much larger swath, like a Goldman? And walk through, if you would, because it is an emerging manager or a new fund of new strategy, maybe you could talk a bit more about how that nimbleness is lending itself to maybe a new way to think about return and your business itself.
That's a great question, Rachel. You know, I think I was very fortunate at my decade at Goldman because I spent the majority of my time in the proprietary trading group. And the wonderful thing about being in that group, it was kind of isolated and insular because we weren't dealing with a lot of the larger firm aspects. It was really about performance and returns. And the wonderful thing for me, being a little different in this industry, is it doesn't matter what you look like, where you come from, how you speak, as long as you can deliver returns at Goldman Prop, you were successful. So I felt very fortunate for my niche within the firm. I really pride myself on having a very flat organization culturally where everyone's idea is heard. We also do a lot with big data. Although we are a fundamental strategy, we do use data, and we use Tableau as well, just like Peter was talking about before, for data visualization, as well as MATLAB for a lot of our back-end quantitative screening tools that we use. But it's building a new firm, it's very important on the infrastructure side. So we were very fortunate to receive multiple seeding offers and decided to partner with a firm that will help us on the infrastructure side to try to alleviate some of the risk on the business side of a new fund. So we partnered with another institution that has $11.5 billion of existing hedge funds on their platform. And that way we have a team of 400 people for our back office, our middle office, our compliance, and we hope that it will make us more, our strategy more competitive as a new strategy.
It's nice to hear that change, that I think even in the last many years when looking at a seed, it was really how big, how much new capital could you get, but looking at the quality of that capital, looking at their understanding that it's not just a transaction, but there's the obligation to the sustainability and infrastructure of your business, is what it sounds like was the winner of those.
It was a very
suitors.
strategic decision, and we actually passed on another offer that was a larger pool of capital. For this pool, the trading allocation is $110 million, but we actually had other offers that were larger, and decided to partner with this because of the infrastructure. And I think so many new funds launch, and our goal is to be long-term and strategic and make it to our 3-year anniversary, our 10-year anniversary, our 30-year anniversary. And so being strategic with our partner was a wonderful opportunity to have a choice.
Adrian, when we've talked, one of the biggest edges one would think without question, is the opportunity cost now, how expensive and time-consuming it is for any wealth advisor, family office to try to emulate or reproduce or replicate what it is you've spent a decade or more to build, which is the manifest of your strategy and your firm. When talking to investors today, are you surprised by how many are still trying to give it a go, as it were, not recognizing the fact that little do they know what they're in for, given the amount of sweat equity and energy it takes to actually build the infrastructure that requires growth?
I think the key phrase there is sweat equity. One of the things that's amazing, 20 years of working in this business, of so much of the entrepreneuriality has been sucked out of our business to a degree. You know, Nancy's out of Goldman's, I'm out of nowhere, really. I'm the family office guy, right? I run family offices that nobody's heard of. So that acts as a bar to a certain extent for what we're doing. Plus, we're very unique in terms of the structure and the fund and everything that we're doing within it. But one of the things that I find quite disappointing is that entrepreneuriality has been sucked. I mean, on a number of factors. A, the sweat equity, obviously. Yes. You know, the sheer amount of graft that has to go in, that we all know about. B is the cost, without a doubt. C, I would say, is regulation. You know, we're regulated in. We're based between Los Angeles and London. We've got a partner from London here. And my COO in London is just drowned with regulatory paperwork because we're regulated by the FCA in the UK and FINRA here. And then obviously you have to go by state basis. That's been a huge learning curve for us, being in the States. And then I would say also as well is there's this definite drive, let's call it the brown suit drive towards people going for brand names. You know, I was chatting to a client outside just now, and he was saying that he's been wrapped up in the PIMCO situation, and people are driving towards brands, driving towards the big super large hedge funds and the super large long only shops, because unfortunately, unfortunately I guess, but to a certain degree, allocators, you don't lose your job by allocating to PIMCO, right? So the hurdles I think have definitely increased since I've been looking at emerging managers.
I imagine.
Yeah.
With so many new managers coming up and so many wooing you for your attention, I would assume that your quick no, your ability to identify some endemic flaw that just says it's not a good fit, must be much more acute, much more fine-tuned.
It's a 20-year, when I first started allocating the hedge funds in 97, 98, I mean, you just develop a gut feeling, a very quick gut feeling, as to whether or not the quick no, whether we'll progress and we'll start doing due diligence on you. Absolutely.
Right.
But we've seen so many start-up hedge funds come and go, and we learned all that learning experience of seeing these people and the mistakes they've made and what they've done, and that's a whole another hour panel.
Right.
But is really teaches you how to grow your own business.
Right.
And not make those mistakes.
Peter Thiel will be speaking a little bit later, as you all know, and one of his recent books, if you haven't read it, I'm halfway through, 0 to 1, is quite thoughtful. The opening premise, which he'll probably speak to, but I'll just corroborate as an advocate supporter, and is the concept of original thought. Not only how exhausting it is, but the fact that most in our business too are just derivations of something else. It's the proverbial cut and paste. Than taking a blank piece of paper and reinventing a new idea, where you're actually a first mover advantage, and how rare and unique that is. And it's not something you even can talk about. It's just something that you have to kind of work through, and all of a sudden you become that thing and recognize it. And he walks through a whole litany of things in the first opening chapter or two that speaks to the exercise one does to arrive at those conclusions. And Adrian, I give you a lot of credit in thinking about the family fund, or as you've outlined, as an example of that, of something that others may have done some iteration of. But to recognize very early on in your career that there was something that needed to be found, and to make the decision to actually whiteboard it and build that, I think is a testament to that innovation that I think is harder and harder to find. And now with the obligation of regulatory and operational risk is even harder to sustain. So I think that that's a real testament to that. Do you?
It's taken us. It's a hard road. One of the hardest roads is the asset growth. Is building your assets under management, particularly when you're doing something unique. And quite frankly, as you know very well, Rachel, it's taken us It's taken us 2 years and 36% for people to go, okay, we'll start looking at it. You know, it's that hard today.
Right. Absolutely. It's a good point. We talked about one of the topics on our panel is technology, new technology. And the question is, you know, is there an edge? Is there an edge in the research that one has, all else being equal? Is there a way in which to capture something that is definable, or is it in fact the interpretation of data? And I'd like Peter maybe talking about technology, both his application of it, but you know, how do you quantify or qualify the edge? Is it in fact the robustness of the data and the way, the immediacy or the organizational way in which to procure it? Or is it the way in which it's perceived and the aptitude and judgment and experience to know what to look for, or both?
I mean, it certainly has transformed. I think the number we had for over 10 years was almost 3 orders of magnitude in I/O operations per second increase in our workstation capacity for fast processing. But there's a problem with in behavioral studies that if you give a computer more data, it usually does better in the model. You give if you're in a well-structured machine learning environment. But people actually, their forecasting performance drops off with more inputs. They've done these studies with horse racing inputs and bookies, as well as trying to predict winners of football games. So our computers have more capability with better data, but we have to balance the behavioral aspect of getting swamped by data and then getting sloppy in putting things together. So I think you need more careful management and more careful investment discipline in using what is now just an extreme proliferation of statistics and data and numbers in front of us.
That reminds me a bit of the heavy weight of transparency and the old adage that you back up an 18-wheeler and said, you want transparency, here's every underlying position, but you're now legally beholden to and obligated to know what those are. So that's almost a fiduciary risk oftentimes one doesn't want to seemingly have. I'd rather the manager aggregate the data they think pertinent to my fiduciary role than to give me an enormous amount of work and say, you figure it out, right? So
we completely agree. I mean, we're happy to give our positions because it's really, there are 2,000 positions. The underlying themes that are driving those positions, nobody else could extract from the data other than us. So it's really much more useful for you to get what we can perceive to be the important risk drivers.
I would echo Peter's comments. You know, there's so much information out there, I think, especially in this technology age, especially looking at asset classes around the world, and you have to have a process to have that data intelligence, to know what's important and what's not, and having quantitative tools to screen the universe and isolate what you should then drill down on is so important in terms of really delivering that uncorrelated alpha.
Is there we keep talking about a lot of the jargon. We had 130/30, portable alpha, and now we're seeing everything from risk parity, risk premia, first loss. We're looking at seeding, anchoring. We're looking at all iterations of just basically getting access to good ideas. And you're seeing a myriad of terms on the front cover of every one of our magazines that are speaking to and trying to rectify that. We used to have classic commingled funds. Now we have SMAs, co-investment, fund of ones, fund of hedge funds, multi-strats. You have one engine and you're porting it in a myriad of different ways. Mm-hmm. You know, Adrian, from your perspective and talking to so many managers out there, which of those do you think might just be illusionary fodder? It might just be something that is unsustainable. Is it all these fat tail hedging and tail hedge portfolios? Is it risk parity, risk premia? What are you hearing that you're separating between kind of saying this is just maybe jargon for something else versus something that says this is actually a compelling edge?
There's a very simple one-line answer to that. If a manager can't ask a simple question in a simple way, and then comes out with excuse the management consultants out there, but comes out with a classic sort of investment management consultancy speak, chances are I will walk away.
Right.
Because if they're going to, I think it's a live feed. If they can cover up a lot of bullshit by bullshit chat.
Right.
Quite frankly.
Right. Right.
And it's, but you know, all of those points you mentioned are all true. I mean, you know, there's a lot of smoke and mirrors that goes behind the marketing materials that you look at and the conversations that you have. And it's very simply cutting through that. I mean, only 50% of what we do is really allocating into managers now. And while these guys are very technology driven and data mining driven, but that's the strategies that you run, Ours is very much more qualitative in terms of it's really bringing our 20 years of living and working around the world in Asia and Europe and America to find unique ideas, and then to due diligence. You know, there's very little point in us looking at databases for what we do.
Right, I imagine.
Yeah.
Is most of that still, a lot of it networking and word of mouth?
Huge amount.
It still is.
Huge amount. It's networking and it's word of mouth.
Yep.
And that can, and quite frankly, that can come from anywhere.
Right.
It can come from existing clients, from conversations here. You know, I wasn't aware of Nancy before, but she's on my calling list when I go to New York next.
Thank you.
And that's how you find ideas.
Right.
It's almost as if I'm not traveling, I'm not working
Right.
to a certain degree.
Right. That makes a lot of
Jargon
sense.
can kind of be a blanket too. It can be a way to cover, so managers don't actually explain what they're doing, and they can use these buzzwords and these terms that are sort of consensus. They're mainstream terms that really hide what they're actually. If you can't articulate your strategy with words, leaving out the jargon, you probably don't have a strategy that either is very unique or is something that's different.
We often talk in our marketing exercises that probably 90% of marketing presentations are what you do, where you came from, all the classic, almost a documentary film versus a propaganda film. You can see all the information, but it's almost a DDQ tutorial versus the most important, which we talked about, which is why. What prompted that behavior? It's almost behavioral finance, which is a wonderful entry point to a discussion, which is what prompted the MO, what gave you the impetus to believe and build the conviction that you did using the tools or factors that you have, and if those changes, what would prompt that change. That kind of arc of that idea is manifest in every good presentation, where you really get down to the behavior of what prompted something. And you're seeing that more and more in asset allocation, I think, where the question is much less what box does it fit, which I really truly believe that's evolving, versus what is the behavior of the instrument itself, in what markets will it do well and not, and why. And building an argument, and a structural argument for that, is much more compelling. And it's ironic in our discussion how few can actually do that well. They can speak much more about what it is, but when you call them to task on why did they enter in that position when they did, or doubled down, or chose to recuse themselves from it, it's one of those finger to the wind, gut checks, I just know. And the degree to which one can quantify that to show sustainability of that process is paramount. Yeah. It's amazing how few can do that well.
The process drives everything. I think that's, if you don't have a process that's repeatable, you don't really have a strategy. So it's all, in my opinion, all about the process.
Peter, when you're talking to some of your clients, which are very well-respected institutions, what is their temperament today? How are they thinking about you, but thinking about the markets? Are you seeing them quite nervous about the changing tide and where they are? I'd just be curious, because you have that level of discussion with your clients, what it is you are finding you need to solve for.
I mean, the thing that keeps coming up is where's the opportunity. Most of the things and our clients typically have a much bigger portfolio, and they're saying that the common theme they're hearing amongst the managers is, I'm not finding enough opportunity. We have other clients that will express that as simply, we expect our portfolio over the next 25 years to produce an 8% return, but over the next 10 it might only be 5, and these would be public plans with broadly diversified portfolios. So I think that's the common theme. People see all risk premium have been bid up, expected returns prospectively in the near term are quite a bit lower. So some people hunker down and accept that. Others are reaching for yield and return and more niche strategies. Lots of people looking for frontier market equities, emerging market small cap, market neutral and emerging market small cap. They're looking for more and more scarce capacity assets that might generate the return targets that they're pressured to find.
Mm-hmm. And are family offices similar? How are family offices thinking today?
Yeah, we provided sort of almost a one-stop solution for family offices with the family fund, but it's also a microcosm of their largest portfolio, but chances are they wouldn't replicate or know of any of our underlying positions. So the theme is, I would say a common denominator through that is, you talk about the fund, you talk about the managers you're invested with, and you talk about your individual positions. And it's the deals and the individual positions that the families are interested in. Mm-hmm. You know, we have our 3 core equity positions are, we have a big lithium play on in North America, we have a managed IT services business in the UK, we have a medical device and healthcare business in the US, we have a water rights deal in North Dakota in the oil and fracking services business. That's what they want to hear about. They want to hear about and that, quite frankly, is the interesting stuff. Do you want me to talk to you about the long, short, or the multi-strat Asia manager I've got? No, it's all about the exciting stuff for the families.
Capturing an arbitrage somewhere, that uncrowded trade that maybe others haven't arrived at yet.
Yeah, I didn't know about that. I hadn't heard about that. That sounds really interesting. How do we access that?
Right, that makes sense. Changing gears, Nancy, during your, let's call it courtship and people wooing you and you potentially wooing them, walk the audience through, if you would, because many of them are looking to grow, walk them through the courting process, and because you've been in the industry long enough to know what one now has to do. How laborious was that exercise in thinking about, one of the topics here is kind of new frontiers, and one of those is the new obligation that we all have in packaging yourself or presenting yourself as a realized entity for that audience to have them move forward. Could you maybe just speak a little bit briefly about that, the time horizon of that courtship and what it is you had to put together to prompt that ultimate partnership?
Yeah, no, that's a great question, Rachel. It's very challenging being a financial innovator because you're doing something that's different, and everybody always wants to know who are you like, who else does this, who are your comparables, who are your comps, and it was a challenge, I think, for us to be able to, it is a different, it's not a new strategy. I've been doing this 17 years, but it is new to the market, and being able to tell your story and package it is something that, from my seat, I've never been in a sales role, ever. I've never done marketing before. And the joke about starting a new business and being an entrepreneur is you have to do something you've never done before, which is, present yourself, being able to articulate your strategy. And I think for me, I'm very passionate about it. I really believe it. And I think that's what came across when speaking with LPs and investors, is really having a different way to do it and being able to articulate without the jargon. But it's definitely a challenge, and I have had my share of meetings that I've messed up and mistakes that I've made, and as a lifelong learner, you want to just take those experiences and make yourself better.
Right. Makes sense. Peter, could someone build what you've been able to build? Is there an opportunity cost today in infrastructure, talent, resources, track record, that if someone young coming out of school says, I've admired you for 20 years, I want to be the next quant equity guy, what would your advice be to them? Would it be, why don't I hire you instead? You don't want the headache of having to build your own, or?
Well, it's taken us 10 years and 11 to get where we are, and we've seen a lot of firms start and fold along the way. So I would admire the ambition and wish them luck. It's certainly a lot harder now than it was then, for all the reasons we've talked about. But again, I'd go back to start with a clear principle, who you want to be and what your culture is. And for us, culture is very key. We have a very clear view of what kind of people we like and what should motivate them to join the firm.
That seems quite rare, though. Everyone says culture, but I'm hard-pressed to think many can articulate what it actually is. Do you find that?
Well, yes, I think that there's probably a lot of jargon and BS when people talk about it. For us, it's we're very team and collaborative. When we hire someone, just interviewed someone yesterday. What do you want? What are you looking for? What motivates you? Want to work on interesting problems? Work with smart colleagues. Mm-hmm. And it's not about the money. It's not about making their number. And that's what drives us, and it's what keeps people there in good times and in bad.
So we're sitting here in 2 years or so from now, as we close up and finish with each of you. Can you just give us some view of, in the context of the market for the next few years, or the next 2 years, let's just use as a proxy, any foresight that you can give the audience and the viewers on what you would recommend one do in the context of your own opportunity? Adrian?
In terms of that's a difficult one for me to answer because we're not really market related. We're out there picking out individual opportunities.
Will those be more fluent?
From pretty much any asset class.
Sure.
And yeah, you know what, Rachel, I have to be absolutely honest. You know,
Well, are those deals
I did see
Yeah.
into the future this morning, actually, when I opened my hotel minibar,
Yeah,
and it told me how much a beer is going to cost in 2020.
there we go.
That's about as far into the future as I can see.
Perfect. That's almost enough. That's fine. Nancy, your perspective?
Yeah, no, it's a very interesting dynamic in the markets right now because of the low level of rates around the world. So we've seen a lot of investors reaching for yield, whether it's, you know, the new term, instead of leverage, it's called synthetic credit, which is leverage essentially in the market. And we have the rise of all these daily liquid products, whether it's liquid alternatives, daily, you know, 40 Act funds that are hedge funds, and everybody has been pushed towards benchmarking on the equity side. Everybody wants to head the benchmark, and also everybody wants liquidity. And at this problem is at the same time you have all these regulatory changes. So you have the Volcker Rule, you have Dodd-Frank, you have Basel III, and especially in the principal markets like the credits, rates, all the fixed income markets are principal. So who is going to provide the price stability to the market? So you have liquidity, but it's going to come at a price, and you're already seeing that in the market. You know, kind of the dirty little secret is that since May, credit volatility is actually up 50%. It's in the 70th percentile over the past 5 years and the 99th percentile over the last 1 year. And probably a lot of that is because of some dislocations that are having because of the PIMCO situation in the derivatives markets. And so you're seeing a lot of rumbling in the markets, which it makes me very excited for what our strategy is. But there's a lot of interesting. I think 2 years from now, this will be a very different place, and people will really understand that the daily liquidity doesn't necessarily mean that it's a good investment.
That's right.
Everybody's running towards liquid alts at the moment, and it kind of feels like the way that everybody was running towards guaranteed notes in 2005. I just think there's going to be some big upsets in that space.
Yeah. Peter, closing out? Any other?
No, I would echo that. I mean, I think liquid alts will probably continue to grow, but there will certainly be some bumps in the road, and there's increased examination emphasis right now from the SEC on whether or not these things really are liquid.
Please join me in thanking Peter, Nancy, and Adrian for their insight and sound today. Thank you very much.